Equities are hovering near record highs while long bond yields and oil prices flash a very different message about risk. This is vTalkInsight, Equity Pulse Daily for May 20th, 2026. Today we unpack how higher yields, energy shocks, and an AI investment boom are colliding to reshape equity leadership and valuation, and what that tension could mean for the next leg of this market. Global equities are trading against a much tougher rate backdrop than even a few months ago. In the U.S., 30-year Treasury yields have moved above 5.15%, approaching levels last seen before the financial crisis, and some houses now flag 5.5% as a plausible line in the sand. Rising 10-year yields around 4.6% are challenging equity valuations and raising concerns that higher for longer is becoming entrenched rather than transitory. Inflation is still running roughly 75 basis points above the Federal Reserve's target and is expected to push higher into the back half of the year, with some forecasts pointing to around 4% as energy and technology-related price pressures build. Market-implied odds of another Fed hike by year-end have climbed above 60%, while central banks more broadly stress a data-driven approach as they juggle inflation risks against weakening growth signals. That mix feeds a classic stagflation fear. Middle East tensions and elevated oil prices are seen by global bodies like the OECD as depressing growth while lifting inflation, and G7 finance ministers are grappling with yields at their highest levels since the crisis alongside constrained fiscal space. Yet current data still show resilience. U.S. retail sales and jobless claims look solid. Same-store sales are nearly 10% higher than a year ago, and the labor market remains stable even as real wage growth slips and excess savings run down. Some allocators now argue that both bonds and equities look uncomfortable at these levels, while others see rising yields as an eventual income opportunity once volatility settles. For equities, the crux is whether upgraded earnings can outpace the drag from a higher discount rate regime. The key watch points from here are long-end yields, wage and consumption trends as real incomes come under pressure, and central bank communication, especially around the European Central Bank's June meeting and the evolving Fed path. Energy markets remain a major swing factor. Tensions between the U.S. and Iran have effectively kept the Strait of Hormuz constrained, with Central Command diverting dozens of commercial vessels and describing the situation as a persistent security concern. Each additional month without a clear normalization of Gulf supply is estimated to add as much as $10 to projected year-end oil prices, helping keep Brent above $110 and gasoline elevated and reinforcing stagflation worries. Overlaying that acute shock is a structural story. A decade of underinvestment in energy and mining has left supply tight, and commodities have quietly been the best-performing major asset class this decade. Analysts now see a credible case for a commodity supercycle that could run another 10 to 12 years as inventories are drawn down, with the risk of sharp, non-linear price spikes in regions such as Asia and Europe if storage hits critical lows. Despite this backdrop, capital is still heavily concentrated in technology. Oil companies are generating free cash flow yields in the mid-teens, compared with essentially zero for some large technology platforms, creating what many see as a significant valuation disconnect. Commentators describe the early stages of a multi-year rotation from growth stocks into hard assets, but note that any meaningful repricing will depend on whether energy shortages intensify and force investors to reweigh earnings durability in resource producers versus long-duration tech. Positioning data paint a nuanced picture of risk appetite. Global fund managers have sharply increased equity allocations, moving from roughly 13% overweight in April to around 50% overweight, the most bullish stance since early 2022, even as they cite inflation as the dominant tail risk. In contrast, high-net-worth investors are still holding close to 20% of assets in cash, signaling a preference to wait for a more meaningful pullback before deploying. The S&P 500 remains close to record highs after a multi-week run, with only modest recent pullbacks and volatility hovering in the high teens. Under the surface, however, there is disagreement over how healthy that strength really is. One camp argues that current index resilience is heavily dependent on outsized earnings growth from a narrow group of AI-linked large-cap growth names, leaving the broader market and GDP forecasts looking softer. The counter-view points to surprisingly broad earnings strength. Corporate profit margins are expanding, helped by shifts into higher margin lines of business and AI-driven efficiency, and 8 of 10 sectors delivered double-digit earnings growth last season, with about 84% of S&P companies beating expectations. Full-year 2024 earnings forecasts have been revised up from 14 to 21%, and longer-term S&P targets out to 2027 remain ambitious, even as many expect a correction and have increased portfolio protection. Breadth, sector leadership, and the behavior of the small AI leadership cohort around key events like NVIDIA's results are critical signposts. The AI build-out has shifted from a thematic story to a macro driver. AI-related capital expenditure is estimated to have contributed nearly 1 percentage point to U.S. GDP growth in the first quarter, with technology sector GDP up about 15%. Companies that have invested aggressively in AI are already widening their profitability gap versus slower adopters, and analysts expect AI-driven productivity gains to support both revenue growth and sustained margin expansion across much of the equity universe. At the project level, Google and Blackstone are planning up to $25 billion of AI-focused data center investment, including a $5 billion equity commitment from Blackstone. Google reports that token usage on its AI platforms is doubling roughly every 2 weeks and is up about 500-fold over 2 years, underscoring how quickly compute demand is compounding. That supports ongoing demand for high-performance chips such as NVIDIA's, even as developers work on lower power options for inference. NVIDIA sits at the center of this hardware cycle. The company is expected to post revenue growth north of 70%, with similar gains in earnings per share, and could potentially surpass Apple as the largest free cash flow generator if current trends persist. At the same time, management still faces supply constraints and extremely high expectations, leaving limited room for upside surprises. Advanced Micro Devices is emerging as a credible alternative, with customers increasingly exploring its upcoming products as a way to diversify away from NVIDIA's shortages. Short-term, the market is applying a much finer filter to tech risk. Chipmakers like Micron and SanDisk have come under pressure as rising yields triggered a risking in rate-sensitive growth names, while commentary from Seagate's leadership about cyclical demand and capacity constraints has reinforced caution. There's been opportunistic dip buying in names such as Micron, NVIDIA, and Microsoft, but also profit-taking in parts of mega-cap tech including Amazon and Alphabet. Outside the core chip complex, AI is already reshaping corporate strategies. Cisco's recent margin compression reflects stepped-up investment to position for AI infrastructure demand rather than any obvious deterioration in orders. Standard Chartered has explicitly tied workforce reduction targets to AI adoption, signaling how quickly automation could alter employment in banking. At the same time, enterprise software providers face margin pressure as customers demand more tailored solutions and push back on price, highlighting that not every part of the software stack is a straightforward AI beneficiary. Deal makers report that the AI cycle is driving a shift towards scale, selectivity, and creative partnerships, while sovereign wealth funds in the Middle East continue to channel capital into technology, AI, and infrastructure despite regional conflicts. Credit markets are signaling a different tone from the government bond market. Even with higher Treasury yields and geopolitical risk, equity indices remain firm and credit spreads are tight, suggesting that overall financial conditions are still supportive. In technology in particular, high-yield issuance has surged from essentially zero last year to roughly $40 billion so far, with many deals reportedly 2 to 5 times oversubscribed, and high-performance computing-related bonds have delivered double-digit returns, far outpacing the broader high-yield index. The picture is less straightforward for banks. CFRA has downgraded Citigroup and Bank of America, citing the risk that the Iran conflict could dampen consumer spending and loan growth, alongside sector-wide concerns around rising costs and commercial real estate exposure. In the UK, Persistent high yields are already straining housing affordability, even as regulatory moves such as periodic reviews of deposit headroom offer global banks more clarity for planning. Yet large corporate M&A volumes are running 35 to 40% above five-year averages, with especially strong activity in financial services, defense, infrastructure, and consumer sectors, and UK mid-cap deal premiums roughly double normal levels. Equity primary markets are also stirring. A wave of high-profile tech and AI-related listings is anticipated, including potential IPOs from OpenAI, Anthropic, Databricks, SpaceX, and Stripe, and analysis suggests that even very large transactions could be absorbed without destabilizing the broader market given current size and liquidity. However, recent offerings from prior disruptor-style names such as Figma and Naven have traded well below debut prices, and much of SpaceX's lofty valuation still rests on revenue streams beyond broadband that have yet to materialize. Investors are increasingly focused on which AI-exposed companies can turn heavy capex into durable top and bottom line growth, a filter that will likely shape how this IPO backlog clears. Pulling it together, equities are still leaning on strong earnings and an extraordinary AI and data center capex boom, just as long-duration yields, energy prices, and geopolitics all push in a more uncomfortable direction. The balance of risk is shifting from pure multiple expansion toward a test of how far margins and cash flows can stretch in a higher-for-longer rate and oil regime. From here, the critical signals to watch are long end Treasury yields and inflation data, the evolution of the Iran and Strait of Hormuz situation, the breadth of earnings delivery beyond the AI leadership group, and any cracks in credit spreads or deal activity as the IPO calendar fills. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.